Hi, this is James Zane with Full Capital, and I'm here with Fritz from Colliers. Fritz, thanks for jumping on. So it's been a crazy summer, definitely hot. You're a little bit better than me,
Yeah,
give us a little bit of your background and a little bit about Colliers, and then we'll jump into what's happening with the market right now.
for sure. No, super happy to be part of the conference and jumping on the conference call with you. So you mentioned my name is Fritz Waldvogel. I'm with Colliers Mortgage here. We're based in Minneapolis, Minnesota. We are a Fannie Mae DUS and HUD FHA lender. So we work a lot with the Old Capital team and a lot of the folks here coming to the conference. So really excited to be a part of the conference again. A little bit what I'm seeing about the market. It's been a pretty volatile couple 4 or 5 months, but I feel like the agencies in particular, Fannie, Freddie, and HUD are just getting a lot more competitive. I feel like with the treasuries rallying down, I mean, just in the last couple of weeks as we record this podcast, the treasury has been down, 10-year treasury is down 40, 50 basis points. So I feel like the agencies didn't do much business in the first half of the year. And so I feel like they're going to be really competitive to close out the year.
Yeah, everybody that I'm talking to right now is like, can we rate lock today? And I'm like, well, why don't we get like the loan size and the loan application first, and then we can rate lock, because it's one of those. Everybody definitely was on sort of the floating rate bridge bandwagon for the last 12 to 18 months, just with rates so low, SOFR so low, and now SOFR is now essentially 2.25, 2.5. And if you're doing a bridge loan, you're probably 3.5 to 4 over that. So you're looking at a 6.5 all-in rate, whereas Fannie and Freddie, they're still sitting around 5%.
Yep.
And so it definitely has shifted quickly, and it's impacted not only buyers and how they finance, but then what sellers can get, because Fannie and Freddie really haven't changed their underwriting criteria. In terms of I guess it's old school in place debt service coverage test of, I need a 120, 125 on in place cash flows. So, I mean, you've been on a lot of the Fannie committees. I mean, what has sort of been their temperature the last 6 to 12 months?
I just feel like I think they were a little, not dumbfounded, but just they didn't really want to change how they underwrote deals. I mean, they're a cash flow lender, and obviously, a lot of the marketplace was underwriting future rents, and I just felt like they didn't really want to push too much on credit to win business. I mean, I think they would push on pricing and maybe some ancillary credit, but the fundamentals of how they underwrite deals, I don't think they felt like that they needed to do that for the long run. So even if it meant losing some business in over a 3 to 6 month period, in the long run, it was really good for their portfolio, because when the market does move, Fannie and Freddie need to be the lender, all the time. They don't really come and go from the marketplace. And so even in recessions and down times, it's their job to continue to provide liquidity for the multifamily market.
So the way I've been phrasing a lot of these conversations is like as a buyer, as an owner, and as a seller. And so from the buying side, I think there's no doubt a pullback in pricing right now. And so you're able to size deals. Before it was like 35% leverage. So now you're like within striking distance of 55, 60, 65%, depending on the deal on Fannie and Freddie, which is great. So that's on the buying side. Maybe talk about on guys who own deals now. We're seeing people maybe who have owned deals for 4 or 5 years. They've sort of executed their business plan. How are they working through this market right now in terms of staying in touch with their asset manager, working through draws? Have you seen anything on the asset management side? I know we did a speaker series on this probably about a year ago, but it bears repeating that you want to stay, because some people don't even know that they might not be on the good side of Fannie. They might not be on the good list for Fannie right now. So they might come into thinking, all right, I'm going to do a Fannie loan on my next deal, and then they show up and something's wrong. So talk about talk about what Fannie does on the asset management side of these deals.
Yeah, for sure. And so us as a Fannie DUS lender, we asset manage on behalf of Fannie unless there's an issue, and then Fannie has their own team that gets brought into it as well. But yeah, I think like it really, like we talked about a year ago, I really think it's important that you stay on top as a borrower, staying on top of a lot of the deferred maintenance and life safety items. As we do our annual inspections, Fannie is have a lot of employees in Dallas, and they'll do drive-by inspections. So just making sure that you're continuing to put money into the property and not just trying to take all the cash out and let it kind of bleed dry. So I would just say, like I mentioned, just continue to put money in your deals. One other thing I was going to say, I forgot to mention was, they obviously get financials that we submit, you guys submit to us. And if they see a deal's got, say a 140 cover amortizing, and you're at a 2x cover, with your IO, it's not a good look when they drive by and you're not putting any money back into the property. So I think, being able to continue to operate these deals well longer than a couple of years, 4, 5, 6 years, will bode well for you and for future terms with the agencies, because the longer they get to know you and they understand that you continue to put money back in these deals and maintain them and do right by the tenants, not necessarily by your pocketbook all the time. I think that goes a long way. So the next time you do your next deal, they'll lean in on pricing or some other credit items, knowing that you're, take care of these assets.
Yeah, it's I guess it's a circle, right? So if you borrow money, make your payments, and then sell the asset or refinance the asset and pay that money back, the bank is more willing to lend you more money, so at potentially better terms, right? So in terms of selling an asset, anything for sellers out there besides remembering to order their payoff? Anything out there? Order your payoff in time. Fannie Mae takes anywhere from 15 to 30 days sometimes on payoff. So remember to order your payoff. Anything else that sellers should remember when they're maybe exiting a deal? Anything that you can think of?
Nothing in particular. I just, I would say also manage, if you can, your yield maintenance penalty, which is becoming less of an issue maybe now than it was maybe 5 or 6 months ago. But, really understand how that payment's calculated, and if you can back into the lowest number or the highest treasury that correlates to how the yield maintenance calculation is calculated, that can be a smart way to save some money on the payoff.
All right. So let's get back to going back as a buyer on these deals. What are you seeing right now in terms of? I mean, you guys are quoting a lot of business. So in terms of leverage, in terms of different prepayment structures, most people, they took sort of the standard yield maintenance, maybe a 10, 9.5 or 12, 11.5 yield maintenance. What are you seeing buyers go in with right now? Like, are they going with a shorter prepay? Are they still looking at the sort of structured arm that Fannie has? What are you seeing out there?
Yeah, it really depends on what your business plan is and how much risk you're willing to take. The traditional, I would say 2018, 2019 plan of just doing, 12-year fully yield maintenance structures. Most people are probably moving away from that depending on kind of your business plan. But we're doing a lot of, 10-year terms fixed with maybe shorter yield maintenance periods, like 7 years, for example, versus 9.5. Fannie still has a step down program that some sponsors like, but they're pulling back a little bit on pricing on that on deals over 10 million. Or so if you get away from just the fixed side, Fannie's floating rate product, the SARM product, has been pretty competitive. We've won some business recently, beating Freddie and some other lenders, and being able to float over, maybe 220. You have a longer term, so 10-year term. You don't have like a shorter maturity like you would on a bridge loan, but you can float over, over SOFR. We've gotten pricing recently at, call it 220 to 230 over SOFR with some IO. And so I think that, people that are willing to take a little bit more floating rate risk, but don't want to have to worry about a shorter maturity bridge loan, that's been a pretty good product that a lot of people have liked. But like we talked about a little bit earlier, all these products, we're able to just get a little bit more leverage on a lot of these deals than we have been over the last 5 or 6 months. instead of 40% leverage, we're getting to, even in larger MSAs like Dallas Fort Worth, for example, we're able to get to 60% leverage, in some of these deals 65% leverage. So I think that's been a little bit more refreshing as we've been quoting deals that at least be a little bit more competitive.
Yeah, I mean, when I sort of started in 2015, 2016, I didn't know any better, but every deal was 80% levered on Fannie and Freddie, and that was a signal to buy everything. So,
For sure.
we're coming up in September. We'll be you'll be here in Dallas at the Old Capitol Conference, but I did want to take you down memory lane, and I know you've been to a few of our conferences. And participated in some of our videos. Any conference or any one of them stick out to you, going back down memory lane here?
Yeah, they've all been great. But I've always liked the sports venues. I remember, I think it was year 2, you guys did the Cowboys Stadium. That was pretty cool to be able to sit up top and you could see your face on the giant jumbotron in Jerry World. Was kind of cool. And then even last year, walking around the Rangers new ballpark, and I think it was just a really unique venue. But ultimately, the reason that I think we enjoy sponsoring the Old Cap Conference and going to it every year, a lot of my team now comes as well, is just the people you get to meet and be in front of so many different folks and within so many different parts of the multifamily universe. So not just lenders and borrowers, but you have different vendors involved, investment sales folks. And so I always feel like it was kind of like an annual conference where it was like a reunion, right? Where you get everyone in one room and be able to connect with and network with so many different people within the multifamily industry. So we look forward to it every year and can't wait for middle of September.
Yeah, I mean, I think especially after COVID, you sometimes forget how fun an event can be. I know we're doing this over Zoom, but in normal times, I think everyone's pretty much back to normal now. And so it'll be great for everyone to come out and see each other. And I think by that time, right now, we're seeing a little bit of a spread between what sellers are willing to sell at, transact at, and what buyers sort of want to pay. And so I think in a couple of months, hopefully that thaws out and we'll be back to just roaring and going here. So I appreciate you coming on today, Fritz, and we will see you in September.
Looking forward to it. Thanks, James.
All right, thanks. Bye.